All right. Well, good morning and welcome everyone to the OneAscent Market Update for Q4 2024. My name is Cole Pearson. As we do every quarter, let me open us in a brief word of prayer as we get our time started. Let's pray. Heavenly Father God, thank you for today. Thank you for this morning. The fact that the sun rose and that you are on your throne, Lord, we're so thankful for that. With all the things that are going on in our world, in our cities, in our homes, and in our lives, Lord, we are grateful that you are on your throne. Your word tells us that your steadfast love never ceases, that you provide new mercy every morning, that you are faithful. And so, Lord, we're thankful for that. Thank you for each family represented on this call. As we turn to talking about the markets and money and the things that bring us to our time today, Lord, I pray that we never lose that perspective, that you are God, that you are on your throne, and we're so thankful for that. And so I pray that you be with us now as we go into our time. And it's in your son's name we pray. Amen. Amen. Well, again, welcome to the OneAscent Market Update call for Q4. My name is Cole Pearson. I'm the president of Investment Solutions. I'll be our host and our MC for our time this morning. We've got some really great content, some really great speakers who are going to share that with us today. As we do every quarter, if you have questions throughout the call, you can send those by email. You can send those to info@oneascent.com. You can use the Q&A function built in here into the Zoom. And many of you are regular attenders of these calls, so go ahead and mark your calendars. Our next call will be January 21st, of 2025. It's crazy how time flies, but we'll be talking about what's coming in the year ahead in that next call. Before we get to talking about the markets and what's going on in the world, we want to talk really quickly about why we do what we do and how we do it at OneAscent. We implement what we call values-based investing, where we want to help investors align their investments with their deeply held faith and values. And so the way that we do that, the way we approach integrating values into investments is with our 3 E's. Many of you have heard us talk about this before, but we want to remind again of the why. So what does it look like to align values with investments? Well, first, we eliminate companies whose products or practices cause harm. There are simply some companies who make certain products and services that we would choose not to profit from, so we don't invest in those companies. But the next stage of that is to evaluate. We are, in fact, investing, and we're going to talk about that here in just a moment. But we evaluate companies to make sure they meet our investment objectives. Whatever product, whatever solution we're managing, we want to make sure that it meets the investment criteria that are needed, whether it be valuation or what's happening in the economy, technical sentiment. We make sure that those are strong and solid. But finally, what it means to integrate or align values with investing is ultimately finding companies that we want to elevate. We want to elevate those companies that are making the world a better place, that are bringing value to the people and places that God has made, but also the people and places that business is interacting with. Its customers, its employees, the suppliers, creation, the local community, as well as society at large. So that's what it looks like for us and how we approach it. We do this through technology that we've built over time. So our proprietary Elevate platform, it's our screening platform that incorporates real-time data to help us analyze individual companies, but also investment managers to make sure they're eligible for our portfolios. It's a system that helps us do all this. We've got 8 eliminate issues, lots of sub-issues. We can screen over 70,000 different issuers. There's almost 4 million data points that are updated on a nightly basis. So that's kind of the way we bring both process and philosophy together. And so for you, I want to make a quick offer before we jump into our market review today. I want to offer a free assessment. If you are wondering what you own and whether or not it aligns with your values, you can go to our website, oneascent.com. You can select Analyze My Investments, that button there. And what it'll do is it'll pop up with a simple questionnaire, some quick questions that you'll answer to begin a discussion so that we can deliver a report that's tailored and personalized to you to tell you whether or not your values are aligned with your investments. And so I wanted to kick our time off just again with a reminder of why we do what we do and how we do that. But now we're going to get to really the heart of our call today, and that's our Q4 market update. We're going to give an update from our asset allocation committee and our outlook on the markets. Really excited to be joined by both Pete and Nathan, who are senior portfolio managers on our team here. But before I hand it off, I want to first introduce Peter Klingelhofer. Pete is our newest team member on the investment team. He joined us in September, just a few months ago. And so we're really excited to have Pete. Pete comes from, he spent his first 17 years of his career working for the Ohio State Teachers System, managing almost $2 billion in large cap money. From there, he went on to JP Morgan Asset Management, where he was part of their multi asset team, helped with developing long term capital market assumptions, overseeing several billion dollars on investors' behalf. Most recently, he's been with several RIAs and a CIO or a managing director position there in the Columbus area, Columbus, Ohio, where he lives with his wife Suzanne of 20 years and their 5 kids. So, Pete, we are really excited to welcome you to our team. Excited to welcome you to the call, and I'll turn it over to you to get us started with our thoughts on the markets. Pete.
Excellent. Thanks, Cole. Double clicking on video there. Thanks for that intro. I'm thrilled to be part of the OneAscent team, and I'm glad to be working with Nathan. Cole mentioned that I used to work on the long-term capital markets assumptions at JP Morgan, and that's something Nathan and I'll be working on here over the balance of this quarter. And you'll see the results of that effort come January. So if we move forward, we'll be talking now about the fourth quarter portfolio discussion. I'll be reviewing what happened in the markets in Q3, and then I'll turn it over to Nathan, and he will touch on our navigator process and investment outlook. And then he'll also review actions that perhaps you should be taking or thinking about in your portfolio, given the current backdrop and outlook. Moving on to what happened in Q3, it was obviously a pretty healthy quarter across the board, and we finally started to see the broadening in the stock market. It's really helpful, and we would have anticipated this. Small and mid-cap stocks outperformed large. That was very healthy. And in addition, we saw international equities, developed markets and emerging markets outperform. In the latter part of the quarter, we saw some strength coming from the Chinese market that helped drive that EM number up. And in addition, we saw the bond market perform pretty well. So during last quarter, interest rates did fall, perhaps somewhat in anticipation of the Fed coming through, and also the economic data was weaker, right? The Citigroup Economic Surprise Index was weaker throughout the last quarter. But as you know, as this quarter has turned the corner, we got a pretty strong jobs number at the beginning of this month, and that's kind of changed some of the tenor in the market, which Nathan will be able to delve into a little bit more. So as we move on to the next slide, we can look at investment returns year to date, which obviously the S&P's been quite strong, but in this most recent quarter, we've seen things develop. Risk assets overall performing quite well. So year to date numbers looking quite good, but as you are well know, at the end of Q2, the spread between the S&P 500 and many of these other asset classes was a lot larger, right? It's narrowed quite a bit because of the strong performance in Q3. We're seeing now kind of a change in leadership, if you will, and we're starting to see mid-small international catch up as the market broadens. I think it's important, as you note that EM spike there, it's important to comment on the fact that China was a big driver of that, right? And one of the things is we're not participating very much in China, if at all. And the reason is because of our values-based preferences, right? China, and if you've been following us for the past several years, you know that we've done some in-depth work on China. Andy Manton has done a webinar on that, and he's also written a position paper on our views on China. And they're very clearly showing human rights violations that we don't think are good for the world, and also intellectual property rights. They have very little respect for that. So that's important to highlight, because when you have these short-term movements in markets, we're not always going to be on the right side of it, at least in terms of when I say right side of it, I mean that our performance might not reflect it because of our values preferences. And those are reasons you hire us. And it's important that we uphold those and that we follow our principles and we do that. So there are times when these things will spike and we won't necessarily be positioned exactly in that, but we are choosing to invest in other areas of the market. And as you can see, small and mid cap did quite well last quarter. So moving forward, we're going to see on this next slide why we're optimistic about the opportunity in small and mid cap. And you can see those yellow bars there that earnings moving forward are going to look much better for small and mid cap companies relative to the large cap or S&P 500. This chart is, as you can see in the note at the bottom, the S&P 500 is the gray lines, and the Russell 2000 represents the wheat colored lines. And the point to make here, yes, it's true that small cap earnings are a bit more volatile. Some of that's related to the difference in profitability between large and small caps. But the other point to make is that when the outlook changes, small cap earnings can really perform quite well. And we're expecting over these next 4 to 5 quarters that small cap earnings are going to look much better on a year-over-year growth basis than large cap earnings. And we would expect that would support investors investing more money in the space, which they obviously were not doing over the past 18 to 24 months. So we would expect portfolios to rebalance over time and to come more towards the way we're currently allocated. And that slide here shows that positioning. If we move on to the next slide, we can look a little bit more into sectors and how the market broadened from looking at a sector view. And as you know, technology has performed quite well over the last couple of years, but in this quarter, technology did not keep up with the markets. And you can see the S&P 500 did extremely well, was up 5.9%, and technology not even up half as much as that bar shows. But you can also see that 8 of 11 sectors outperformed the S&P 500. So the market clearly, another way to express the market broadening, very positive for our portfolios. And actually this is, and as we move on to the next slide, we can talk a little bit about how that looks relative to year to date. And this is kind of how leadership changes. When you have a long period where you've seen dominance by one area of the market, when the leadership does change, you start to see other sectors performing well. And who would have guessed at the beginning of this year that utilities, by the end of the third quarter, were going to be outstripping the returns from technology, right? That's probably a big surprise for many people. And you can see that many sectors now are doing quite well on a year-to-date basis. So this is very much a positive for the markets in general at this point. And we don't need to rely on performance from technology to get decent returns from the market going forward. The rest of the market can behave a little better. And we also know there's huge valuation spreads between technology stocks and the rest of the market. So with the earnings backdrop improving for other areas of the market, we would expect this trend to continue for the foreseeable future. And we believe we're positioned well for that. So, and at this point, I think it's time to turn it over to Nathan, and he'll give you a little bit more color on macro backdrop and how we're positioned in through the Navigator.
Thanks, Pete. It's good to be with everyone today, and it's great to have Pete aboard. It's been fun working with him, and he's a great addition to the team. So what I want to do on this slide is talk a little bit about why investment returns were so good in the third quarter, and it's going to provide a really good transition into our Navigator outlook and our process there. So the title of this slide is that the Fed's focus shifts to the labor market. It's important to remember what it shifted from inflation. So for the last 2 years, inflation has been the story. Well, the Fed believes it's kind of cured inflation. Inflation is on the way down. And so because of that, the Fed decided it was time to begin lowering rates. And so they did that in September, and the market has been anticipating that. But let's remember why they did it. Okay, so we're going to add a couple other lines onto this chart to illustrate why they started to lower rates, given that the focus is on the labor market. So first, they did it because job openings have been declining. That's this light blue line. Second, they did it because wage growth has been kind of stagnating. It has not actually kept up with inflation since the pandemic. And so those are two things that are not particularly positive for the consumer. And a third is that unemployment has begun to rise. And if you look at prior recessions, the unemployment rate usually rises before the recession. And part of the reason why these three pieces of data are important is that they affect consumers, but they, more importantly, affect the consumer outlook. They affect consumer sentiment. If you recall from your economic studies, 2/3 of the U.S. economy is driven by consumption. So we are a consumer-led economy. Therefore, jobs need to be plentiful and they need to be filled, and wages need to be going up in order for our economy to perform well. So the Fed is lowering rates in order to stabilize or attempt to stabilize the job market in the hopes that that would give us the soft landing that the market hopes for. So I wanted to just kind of make sure that we all put a stamp on the fact that inflation, at least for now, is last year's story, and we need to be focusing on the labor market as we think about with the Fed and lowering interest rates further. So how do we frame our work? We do it through the Navigator Outlook, and we have 4 components of that. We'll start first by talking about the economy. We'll talk about market technicals and market and investor sentiment, and then we'll finish up with valuation before we talk about what you might want to do in your portfolio. So first, if we're talking about the economy, the first thing we need to think about is growth. Third quarter growth expectations remain strong. And so what we're looking at here is a chart of the Atlanta Fed GDP Now estimate. And so this GDP Now estimate is what's called a nowcast, where what they do is they take every piece of economic data when it comes out. Every week they update this, and they say, if things progress with what we know and what just came out, what do we think the economic growth will be? And if you look here, all throughout the third quarter, it's been at the high end, and it's become higher than the consensus of Wall Street economics forecasts. And so this is really, really strong. And this is maybe not what we would have expected or thought about, given that a year and a half ago we had a banking crisis. We're still kind of feeling the effects of COVID in the economy, and everything's not back to normal. So why is the economy doing so well? One of the things that we need to really point to is fiscal stimulus. And so this is a chart of the fiscal deficit. So when it's above the zero, that means we're spending more than we earn as a country. In order to kind of focus on this a little bit, I'm going to put some graphics up here to illustrate. So this blue line is our current level of deficit. And you can see to the left, in the past, there have only been 3 times when we have had a deficit higher than today. The first one was during World War II, which is obvious. The second was during the global financial crisis, where the Fed and the government really had to come in and save things. And then the third was during a global pandemic, which was a huge crisis. So we are spending today as if we are in a world war, financial crisis, or a pandemic, okay? So I would ask you, are we in a world war, a financial crisis, or a pandemic? And the answer is no. The economy is actually doing really, really good. I just showed you that. Third quarter growth is going to be over 3%. 3.4% is the estimate. We are spending so much more than we are making, and that is really driving growth. And so to put a little bit even more focus on it, what I did is I pulled up all of the recessions between World War II and now, where we just had kind of an economic recession. So the dates here are 1949, 1953, 1957. 1960, and then 1970, and again, the oil crisis in 73 and 74. Then we had a recession in 1980, and again, a double dip recession, 81 and 82. Then there was a recession in early 1990, and then in 2000 at the bursting of the tech bubble. All of those recessions had lower deficit spending than we are having today with the S&P at all-time highs and the economy growing at over 3% for the third quarter. So I think the answer here, or the takeaway here, relates to politics, but I'm not going to talk about that yet. We'll come back to politics. But this is a huge piece of the information we need to know to understand why the economy is doing so well, and that it will likely keep doing well as long as the government keeps spending money. So that's fiscal. The other half of this is monetary. So what happens when the Fed cuts rates and they keep cutting rates? Well, there have been 8 rate cutting cycles, since the 80s, and we're going to look at those. So the first thing to look at is the middle line, and you can see the number there at the end of that line is 8.5%. And what that means is over the 18 months following the first rate cut, so the first rate cut was in September, over the next 18 months, it returned an average of 8.5%. Remember, though, that the S&P 500 has returned on average about 10% over the last 100 years or so. So over 12 months, we've earned more than we have earned over an 18-month period following rate cuts. So rate cuts by themselves aren't automatically great for the economy. So what factor speaks to what is good and what is bad? And it's the other things here on the slide. So the red at the bottom, if they're cutting rates because of a recession or during a recession, the market tends to do very poorly. On average, a 14% loss over 18 months. But if they're cutting rates kind of for protection, for insurance, kind of to keep us from going into a recession, stock market tends to be up 30% on average over the next 18 months. Hopefully, we are in the insurance rate cut, right? The Fed is trying to engineer a soft landing. And so as long as we stay out of a recession, we feel really good about the stock market. If we were to go into a recession, we would feel pretty negative about the stock market. And so that's very, very important for us to watch indicators about whether or not we're going to go into a recession and what factors might keep us from going into recession. One of those factors, as I talked about, is the consumer. And so as we go to talk about market sentiment, this is the first place we go to a negative or a red in the upper right-hand corner. So the Conference Board consumer confidence number at the top of this slide, you can see in 2021 when it peaked after the pandemic, it still didn't get back to confidence levels seen before the pandemic. And so it's really worth noting that consumer confidence has not regained the levels since before the pandemic. And then if you look over the last 3 years, it's just kind of been stuck in the doldrums, okay? And so what might be behind that? On the bottom, I plotted one of their data points where they survey people and they say, are jobs plentiful or are jobs hard to get? And so they track the percentage of people who say jobs are plentiful minus the percent that say jobs are hard to get. And that's the number plotted at the bottom. Then what I did is I said, okay, if the number, that net number of plentiful minus hard to get is better than the prior month, we're going to make it a dark blue. And if it is getting worse, we're going to make it a light blue. And so if you look here at the last 8 months, this metric has gotten a little bit worse every month. So for 8 months in a row, the percentage of people saying jobs are hard to get relative to those saying it's plentiful has gotten a little bit worse. And again, remember why this is important, because 2/3 of our economy is the consumer, and consumer confidence drives spending decisions. And so this is a risk to our hope and the market's hope that we're going to avoid a recession. So it bears watching. Finally, looking at valuations. If you've been participating on our conference calls at all for the last quarters, you know that we don't think the S&P 500 is cheap. We think it's fairly expensive. We show several different metrics: price to book, PE, price to cash flow. The one we're showing today is one we often show, which is price to sales. And we show this one oftentimes because the line is just a little bit smoother. Earnings really bounced around a lot during the tech bubble and the global financial crisis. And so it's just kind of a little bit of a smoother line. But I will say to you that all the other ways we look at valuation have a similar story that the chart tells you, okay? And it tells you 2 things. First of all, the S&P 500 is a lot more expensive than it normally is. A lot more expensive than it normally is. Second, It is much more expensive than small and mid stocks, and it's much more expensive than international stocks. And so this is very supportive of our worldview that we think the market is going to broaden. We think there's a catalyst in earnings, and we think the setup is there because valuations are much more stable. If you look at mid cap and the gold and international stocks in the blue, they're not cheap, but they're not excessive at this point. They're relatively close to their long-term averages. So the S&P 500 is not cheap, but there are opportunities elsewhere in the market. So we feel very good about a very diversified, broadly allocated portfolio. So to kind of wrap up our Navigator outlook, the right half here, the economy and technicals, are positive because the Fed's going to lower rates and fiscal stimulus. Our politicians are going to continue to buy our votes. The technicals are positive because rate cuts, as long as we're out of a recession, are going to lead to stronger returns, and the stock market is broadening, which is really, really good. Consumer confidence declined. We didn't show this, but investor sentiment is very, very excessively bullish. And then finally, valuations are not particularly attractive for the S&P 500, but they're pretty good for the rest of the market. So how does this relate to our outlook? And so since we're in the fourth quarter now, let's go ahead and go look at fourth quarter and 2025. So we've got a few issues we thought we would just touch base on real quickly. So first is growth. As we talked about, the Fed rate cuts and fiscal stimulus are very supportive. So we feel good about growth. Inflation appears to be under control. It's last quarter or last year's story. The hoped for soft landing. This is priced into the market. And I think the key thing that we would say here is now is a good time to think about managing risk, because there is a risk that the soft landing doesn't happen. There's a risk that inflation spikes because interest rates may not be dropping enough to really kind of lower inflation. And then on the other side, there is a potential still for a recession. So we think it's actually appropriate to manage risk with the S&P near or at all-time highs. China has been the story, both good and bad. They've done a lot of stimulus, but the market's not been very impressed by that. And so we need China to have some sort of recovery for the emerging markets and then for the rest of the global markets to perform well. Then finally, the election. We're not going to spend a ton of time, unless somebody asks a question, talking about what sectors may perform well. The key thing about the election doesn't matter who wins. The deficit is going to grow. The deficit, rather, is going to grow regardless of who wins. We have analysis that shows you that regardless of Harris or Trump winning, they are both going to spend more and make the deficit worse than the trajectory that we have today. So that's not an optimistic take, but we encourage you to vote, and we encourage you to push politicians to be fiscally responsible. So finally, how would we invest our portfolios? Let's talk about how we are investing our portfolios. We generally gravitate towards talking about our moderate portfolio, our 60-40 portfolio. And there are a couple things to note here. First of all, we're very, very diversified. We have 17.5% in large cap, the same amount in small and mid, and then just a little bit less than that in developed markets. And then in emerging markets, we actually have a tactical overweight there that we actually put on based upon the economic growth and earnings before the China stimulus. So it hasn't necessarily paid off yet because our portfolios are not that exposed to China, as Pete mentioned, but we have an overweight there. And then in the bond market, we're very, very diversified as well. It's worth noting that we have a low-end holding in high-yield bonds because they're fairly expensive. And what I mean by that is spreads to treasuries are fairly low. So with that, I'm going to wrap it up, and I'm going to pass it back to Cole to see if we have any questions for Pete or I.
Yeah, great. Pete, Nathan, thank you both for sharing with us this morning. Again, as a reminder, if you have questions, you can send those to info@OneAscent or use the Q&A function. Nathan, you were touching on it just a little bit, but we have gotten a few questions. Obviously, the elections are coming up in a few weeks. So can you unpack a little bit more about kind of how the elections will or won't impact the markets? And for those on the call, some of you may have been with us last week. We had our annual advisor summit, and an interesting response on a panel that Nathan was moderating was the fact that there are elections going on around the world. Actually, 50% of the world's population is going through an election cycle right now. So maybe, Nathan, could you speak to, obviously, our election here at home, but also maybe the broader perspective of that as well?
Yeah, I think the broader perspective for elections across the world is that we should expect more volatility. Whenever you have um, political change in America tends to be very, very smooth. Political change in most other countries tends to be a little bit more volatile. And so I think that's really the takeaway in terms of the non-US, the global markets. What I did is I just pulled a slide that we use in our weekly commentary, and I'm going to pull that in here and show you now. This is what I was talking about. This is from the Committee for Responsible Federal Budget, and it's based upon the Congressional Budget Office baseline. And so that baseline is in black here. So if you see here, the deficit is expected to grow, or rather is to grow, and then debt will increase to 125% of GDP under baseline. Okay, under the Harris plan, it's going to increase more. And under the Trump plan, it's going to increase even more. And so this is really not optimistic for our economy. We really need to fix this. And that's, to me, the most important thing to think about. Everybody wants to know how the market is going to react to a Trump win or a Harris win. But I would say volatility is another thing to expect. I went back and looked. If you want to go do some internet search for both the betting odds polls and the political polls leading up to the 2016 election, the betting odds had Hillary Clinton at 88% chance of winning, and we know Donald Trump won. And the polls consistently had her winning. So I would say right now, I think a lot of the polls have a dead heat or fairly close to a dead heat, and some of the betting markets are predicting a Trump win. But I would not really put too much stock in any of that and expect to have volatility. The other thing I would say is we probably won't know when we wake up the day after the elections, and that will probably be not America's best time. So buckle in for that. But really, what I would ask is think about ways that we can put forth politicians that might do something good for the deficit, because we really need to get that under control.
Great, thank you, Nathan. One of the things that I often hear said is that at least the markets love a split, and so if one party takes over, the House and Senate and the White House, either side, the markets don't like that. They like the split. So Pete, maybe you could chime in here if you come back on camera. What are some of the more intermediate to longer term implications from an outlook standpoint that to tack on to what Nathan was just sharing?
So I think Nathan shared two charts, one in his presentation about the direction of the fiscal outlook, and then the one you just saw about what it would look like under Harris versus Trump. And the real issue I think we need to be thinking about is that it's been a long time since we've had fiscal dominance for a prolonged period. It's one thing to have fiscal dominance for a cyclical response to something like a pandemic. It's another thing to have this kind of fiscal dominance lasting for a period of years or even into the future. That Nathan mentioned volatility. Well, if we have more volatility and we have a more fiscally dominant world, it may mean that earnings hold up. It may mean that GDP continues to make progress, so we have less likely of experiencing a recession. But it also should mean that discount rates are rising, and that means PE multiples should be falling over time. And we've obviously been living through a period with high valuations. And if you think about the response to the pandemic, a lot of surprise and fiscal support helped drive earnings growth. Well, now we need fiscal support to keep earnings growth. Well, that's not the same, right? And that will create risks. So the risks are changing now as we're seeing the economy slowing, even with this kind of support. So that's something we need to be on the outlook for. And actually, given our preference for the more responsibly valued end of the market, we think that these valuation compressions that should happen over the next several quarters are going to favor the way our portfolios are positioned.
Pete, you were just speaking to valuations, speaking to earnings. You touched on this a little bit, but we had a few questions related to earnings and some of the surprise that you mentioned. So can you talk a little bit more about the question here says, can you talk a little bit more about the earnings outlook for 2025 and estimates, and what are you doing as a result of that in the portfolios?
Right. Nathan and I've had a lot of discussions about the fact that the outlook is very optimistic. Earnings, people are looking for double-digit earnings growth next year. That's quite typical from the sell side projections. Our view is that it's unlikely that earnings can be that strong. So we would expect the earnings outlook to kind of fall back in line to more like a 6, 7, 8% kind of earnings growth. But we also believe that small and mid-cap earnings, at least through the middle of this year, year over year, their earnings were still down, right? So their earnings haven't recovered yet. And if we think about how much talk of the Mag 7 has gone on, the other 493 of the S&P 500 did not have positive earnings growth year over year for the first half of this year. So the optimism from analysts, there is a possibility that earnings could surprise us next year. And if we get that type of fiscal response from this election, then that possibility is probably stronger than many people believe. So that's one thing we have to be conscious of in the earnings outlook and not get too pessimistic, because as Bob Dahl pointed out over the last few months, outside of recovery from a recession, earnings have never had 2 years in a row of double-digit earnings growth. And that's basically what's been baked in the cake. So we historically, we would say that doesn't make sense, that we wouldn't see that. But of course, the problem that we all have to keep in mind is that with this cycle, nothing has gone according to plan. So we have to be ready for things to not going according to plan.
Yeah, thank you. We've got time for one more. There's a few questions in here. We talked a lot about equities and the stock market. So Nathan, I'll give this question to you and kind of just let you take it. Can you talk a little bit more about interest rates? What's the interest rate backdrop? With the Fed cutting, why have bond yields started to go up? Talk a little bit more about fixed income. It's obviously a key part of the portfolio for most investors, but it doesn't get a lot of airtime. So what's going on the interest rate side?
Yeah, what I'm going to do is I pulled in a chart from 2 weeks ago, weekly, and we updated it. And so this shows mortgages. This goes back to the 90s. And the gold is the current mortgage rate. And the blue line or the gray line is the average rate on outstanding mortgages. And what's really important about that is how much it's changed. So as inflation spiked, rates went up, mortgage rates also went up. And this is relevant because what you see on the very, very, very far right of this, which is just a quarter, but you can see right here is where the Fed lowered rates, and in the month since then, rates have shot up. Okay, so why is that? And how does that relate to mortgages, and how does that relate to corporate debt? So the reason they shot up is because we have had strong data since then that has made the market worry that the Fed won't cut rates as aggressively. And so if the Fed doesn't cut rates as aggressively, inflation might spike again. The higher rates will flow through, and particularly as we look at mortgages here, mortgage rates or owner's equivalent rent is one of the big things that has kept inflation higher. Okay, it's kind of the last thing to come down. And so if mortgage rates stay high, that's going to be negative for bringing inflation down. And then the other part of this is this hurts consumers' balance sheets. And the same dynamic exists in mortgage rates as exists in corporate debt, right? So the current loans you're getting, the current rates you're getting on a loan rather, are much higher than all the other outstanding debt you have. That's going to act as a headwind for companies as well as consumers. And so this brings in the risk both of inflation and a recession because of the outlook for rates. So that doesn't sound incredibly optimistic. But the bright side of this is bond yields are far more attractive than they have been in quite some time. So in terms of investors, we're getting these yields. It's actually really, really good, but it presents a risk to the economy.
Thank you. Well, that's all the time we have today. Nathan, if you'll go back to our final slide again, thank you all for being with us, for spending part of your morning with us. We don't take that lightly, and we appreciate it. If you'd like to learn more or follow up, we have all kinds of resources. We stand at the ready to share those with you. You can get in touch with us via email or on our website, or give us a call. We'd love to talk with you. But thanks so much. That'll conclude our call, and hope you have a blessed rest of your day. Bye-bye.